Today I'm gonna share 3 reasons to be bullish and 3 others to be bearish on the tech giant Oracle, as well as its stock fair value calculation, so we can compare it with current prices. Beginning with my bull arguments, Oracle has many different enterprise software solutions in incredible business segments. Their products are mainly divided in 3 big categories: Oracle Cloud Infrastructure, which is similar to AWS and Azure, designed to run all cloud-native, web-scale, and mission-critical workloads. Oracle Cloud Applications, where they have cloud services like ERP, enterprise resources planning, supply chain and manufacturing, customer experiences and human capital management, tools that almost any company needs. Lastly, they have a division called Hardware and Software, where their main products are pretty famous: Java, a very popular programming language, and MySQL, the most used database management in the world. All these segments are core to their customers' operations, have no seasonality issues, and tend to keep growing as online businesses become more relevant every day. Another thing I like about these businesses is their margins. Oracle's gross margin is around 80%. This is really impressive. Very few companies have such high percentage. Their net profit margins are also pretty good, being almost 30% in most years. Note that their fiscal year starts in June and ends in May, which makes things a bit confusing to explain. Right now, for example, they just reported Q2 of 2023, a quarter that ended in November 2022. So, every time I mention a year in this video, consider the sum of June to December from the previous year with January to May of the year I mentioned. About the massive decreases in 2018 and 2022, these were due to one-time events: a tax adjustment of $7.8 billion in 2018, related to a new tax act, and a lawsuit they lost against HP, resulting in an expense of $4.7 billion in 2022. I'll talk more about it in the bearish arguments. Although Oracle is involved in these amazing markets, they have been kind of stagnated in terms of growth for the last 10 years. But this seems to be changing now. They have been growing faster in the last few quarters. It's important to note that they acquired Cerner, a healthcare cloud-based software company, and their numbers started being added to Oracle's 2 quarters ago. This last quarter, for example, they grew 18% in revenues, from $10.3 billion to $12.3 billion. However, Cerner's revenues were responsible for $1.5 billion in that increase, so without that acquisition, Oracle's revenue would have been $10.7 billion, a 4% increase. Another important factor to keep in mind is that they are a global company, and like every other big tech, they are suffering from the effects of foreign currency fluctuations. In a constant currency basis, their revenues would have been 7% higher. According to management, this growth is mainly a result of their applications transitioning to the cloud and also their new cloud versions being so much better than the competition, something I'll get into later on the video. One thing worth to point out is that according to Larry Ellison in the Q1 2023 conference call, a multi-cloud era has began. They closed deals with Microsoft and Amazon so they can have their Oracle's database and other cloud applications available for companies using Azure and AWS cloud infrastructure. As they are leaders in the space, this tends to be a wonderful deal for Oracle. They also acquired some interesting new customers, such as NVIDIA for Oracle Cloud Infrastructure in Q1, which shows they really have something going on here. A company like NVIDIA wouldn't work with anything but one of the best. So far it looks great, doesn't it? Unfortunately, things are gonna get a bit ugly on the reasons to be bearish on Oracle stock. I've analyzed a lot of tech companies during the past few months, and Oracle has the worst balance sheet by far. They have about $7 billion in cash against a $91 billion debt. They also have $11 billion in income taxes payable. For a company that has been profitable for such a long time, this looks to me like they made some bad management decisions. They acquired this huge debt mostly to repurchase their own shares and more recently to finance the Cerner acquisition, a $28 billion deal, which I won't judge. They probably did a deep study and obviously believe it's worth it. About them borrowing money to repurchase shares, I'm not sure if it was the best strategy for them. Apple does something similar and it works really well, but there are a few differences here. Apple is the biggest and arguably the most reliable company in the world, and because of that, all banks want to work with them, lending money at lower rates than they usually would for other customers. I went through their annual reports, and Apple's interest rates is between 0.03 to 4.78%. On Oracle's case, their interest rates range mostly between 3.5 and 4.5%, with a couple of them being above 6%. Another difference between Oracle and Apple is that in the last 10 years, Oracle basically stayed flat in terms of both revenues and earnings, while Apple grew both of them significantly. So, at least in that period, it made a lot more sense to borrow money to buy Apple shares than Oracle's. Apple also didn't get to such elevated levels of debt in relation to their operations. Their annual profits are almost as big as their entire debt position. And they have a good amount of cash on hand, $48 billion, as well as $120 billion in long-term marketable securities, generating enough income to cover their interest expenses. Oracle doesn't have any of that. Look how bad this chart looks in comparison with the last one from Apple. Because they have such a stable and profitable business, this doesn't worry me to the point they could risk going bankrupt, but it's gonna take decades to pay off this debt, and until then, a big part of their cash flow and profits will be significantly impacted. They need to pay over $26 billion just in the next 5 years. As we've previously seen, Oracle has great profit margins, but in 2 out of the last 5 years, they had unexpected expenses that impacted them significantly. They had a $7.8 billion tax expense in 2018, an amount that is being paid over 8 years, related to the application of the one-time transition tax to certain foreign subsidiary earnings. They ended up the year with a $4 billion profit instead of the $12 billion they would have done. In 2022, they registered a litigation loss against HP of $4.7 billion, which almost cut their profits in half. Basically, they did a bad deal in 2011, didn't honor it, lost in court in 2016, had all their appeals denied, and only now in 2022 registered the expense. I went through their other litigation cases disclosed in the report, and it doesn't seem to have anything that relevant, so hopefully this was a one-time thing. But still, I think 2 major issues in the last 5 is enough to at least make me a bit more cautious. My third reason to be bearish may also end up not being a big deal, however, it concerns me more than the litigation risks. As I never used their products, I don't have a deep knowledge about their advantages, so I might be wrong here. Let me know in the comments if you have an explanation for the concerns I'm about to share. I just listened to their last 2 conference calls, and it felt like I was being pitched by a sales team instead of actually being told the reality. According to management, all their products in all categories are far better than all competitors. They say during each call how their Fusion ERP is much better than SAP, and that Oracle Cloud infrastructure is faster, cheaper and more secure than AWS. To me, it's pretty hard to believe in these things, and it makes me very uncomfortable as a potential investor. I'm not sure if I can trust management. I mean, they are almost insignificant in the cloud market, with 2% market share against 34% of AWS, and it's not like they are just starting. I remember an interview from Larry about 4 or 5 years ago, and he was already bashing AWS. On ERP, I found a lot of different data that don't really match each other in terms of market share, but one thing they all have in common is that Oracle is not that relevant. The only segment I'm confident they are the best is database management, where they are in fact leaders. These guys actually invented the market in 1979, 2 years after launching the company, and have been dominating ever since. One last thing I want to mention is that in the last 10 years, while Oracle barely grew, all their main competitors like Amazon, Microsoft and SAP had strong growth. So, considering all these things, I'm not sure I buy their story about having better and cheaper products. Maybe their newest versions of every product is in fact pretty good. I'd like to wait a few more quarters and see how they do, if they are in fact gaining market share, the synergy they will build with Cerner, and if this growth is really sustainable long term. Moving on to valuation. As usual, I'm gonna do 3 different scenarios, all considering assumptions for the next 5 years. For revenue growth, we've already went through most of my thoughts here. I'm excited they are finally seeing growth again, but I'm not sure how sustainable this is. Another important point is that due to the segments they work and their long history of success, I don't expect them to have a decrease in sales, even in the worst scenario. As their growth in the next 2 quarters is practically guaranteed just by adding Cerner, I'll consider a very small increase of 2% per year on the worst case scenario. For the base case, I'll do 5% average increase in the next 5 years, and for the best, 8%, considering they will really maintain this recent growth. Share change. Something really interesting with Oracle over the last 10 years is that although their revenues and profits stayed kind of flat, their stock price went from $25 to $80. This price appreciation is mainly due to their aggressive share repurchase program. Take a look at their shares outstanding in this period. This is why it's so important to always look at what companies are doing with their shares. The same way Oracle was able to increase significantly shareholders' position in the company, it can go the other way by the company diluting shareholders. If you only look at growth and don't consider the shares being issued, you can get in big trouble. But anyways, getting back to the estimate here, Oracle's buybacks in the last few years ranged from 4 to 12% per year. As their balance sheet is looking so bad right now, and they also just did a $28 billion acquisition, I would expect them to slow down a bit here, at least until they are back in a more healthy cash-to-debt ratio. So I'll consider a 3% repurchase in the worst-case scenario, 4% on the base and 5% on the best. On profit margins, we have two potential problems here. If it wasn't for them, I would easily go with high 20s on all scenarios, but one of them is the litigation risks I mentioned during the bearish arguments, and the other is the Cerner acquisition. They started adding Cerner's numbers into their financial statements 2 quarters ago, and the 80% gross margins immediately dropped to 73%, something that ended up having an effect on the net margins as well, coming down to 14%. It's normal for the synergy between two big companies to take a while until starts paying off, but it usually does happen, so let's be optimistic here and consider they will improve this 14% going forward, so I'll do 19% on the worst case. But I don't want to be too optimistic. I don't think they will achieve high 20s as an average for the next 5 years, so I'm considering 22% on the base, and for the best, 25%. For P, because they don't have a high growth history and also have one of the worst balance sheets I've seen, I have to go lower than I usually would for what I believe to be stronger companies. I'll do 9 on the worst case, 11 on the base, and 13 on the best. On expected returns, I always go with 15% for all scenarios, a pretty good annual return, and also a safety margin in case I'm wrong. Let's find out the fair value for Oracle stock now. Keep in mind that this is not financial advice. Starting with the worst case, the fair value for the stock is $31, meaning the current price needs to drop 62% to get to fair value. For the base case scenario, I got a fair value of $50, 40% lower than the current price of $83. The price on the best case scenario is $76, which means the stock price is still overvalued, but pretty close if these assumptions are right.